Okay, now these next two charts, I want to dive a little bit further into this double top concept, double top idea, because it is one that I've seen people talking about on Twitter, and for once, it's actually a narrative that's worth thinking about. Very, very rarely does this happen, but it is one that's worth considering because, markets, they don't rhyme, sorry, they don't repeat, but they do rhyme. But ultimately, why would they rhyme? It's because we have the same supply dynamics. Too many people selling, not enough demand coming in, probably a bit too much leverage. Sounds familiar, right? Now, if we look at this as the USD or the realized cap density, so basically if we look at in terms of price, these dark purple zones, this is where the most amount of coins were accumulated, dollars were invested, and they remain held at that point. Now, we've got two price models overlaid on top. We've got the true market mean, which for my purposes is where I suspect a bear market floor. Whenever that bear market arrives, this is the level I'm going to be paying attention to. It is the zone where the average active investor has their cost basis. So basically, it's the midpoint. Historically speaking, it's been the midpoint of Bitcoin. It is basically that pain threshold where there's going to be very, very few speculators still in the market. And to go too far below that, we probably need to see some of these treasury companies implode or something nasty has to happen to get us too far below that. So that's my current base case thinking. It's an untested thesis, but that's where I sit at the moment. If you haven't heard me talk about that before, I have a piece called Rethinking Bears. That's probably worth having a read because that shows how I derive this model and why it serves the purpose that it does. Now, it's currently sitting at the top of our chop consolidation range from 2024. I believe this will continue to be macro scale. I struggle to see a world where we get too far below this zone. I think that the market will defend this. This is where Bitcoin proved that it's $1 trillion asset. We belong above this. In my opinion, we belong above this. If I'm proven wrong, I'm proven wrong, but I think that we belong above this area. So therefore, if that assumption is true, we have to just look at our, basically everything above 75K is kind of this is our gameplay. This is where the match is taking place. Now, we have a huge amount of this demand and hodling that's going on from like 95 to 100. This was the next major zone. Short-term cost bases are starting to migrate its way through there. Let's just allow ourselves the assumption that we go higher from here over the next 6, 12, 18 months, whatever it is. By the time we have the next bear and we've gone to some higher price, I suspect the true market mean it's heading towards this zone and the short-term cost bases will follow us higher. Now, in the immediate term, we're starting to get some density forming up here. It's not the densest region, but what could, if you think about this what could change this thesis and say, well, guys, maybe we are actually moving into a bearish environment and it actually may look a bit grim for the next 12 months. Let's just visualize what that might look like. Well, the first thing would be all these people who bought up here at 195, they weathered the storm down to 75, and then we sprang up to a new all-time high, and suddenly they're back in profit. Massive sigh of relief. Oh, good. Okay, I made the right decision of hodling through that and probably stacking more. And then the market starts to soften and trade back down to their cost base, and they go, all right, one more bite at the cherry, and they do it with just a little bit less conviction than they did down here at 75. Okay, we're doing this again, and then we get below it again. We go down to 95 to 90. Suddenly they're like, oh, hang on a second. Where are the bulls? Where is everyone? Now I'm not feeling so confident. So getting down below the short-term cost, and by the way, this is just a general framework that I use. If we are above the short-term cost basis, it is okay to be bullish, and I will remain bullish until we get below that short-term cost basis. Based on everything we've covered so far, there is a chance that we go back down to it. Now, by the way, we can break below it and we can chop around it. That's actually quite normal, especially this cycle. I don't particularly want to see that happen. If we break below the short-term cost basis, it's going to be one bear market goggle on time because that would be a sign of meaningful weakness. We should not go down there. If we do and we get below it, we're starting to get really close to putting all these people and saying, hey, you actually might have made a mistake. And there's just going to be, it could be the thing that shifts sentiment because like, what do you mean? Why aren't we at 150K? And people go, I've had enough. That's it. I'm done. This bull market sucks. You might actually get that flip over. So it's something I'm just being very cognizant of. So let's actually look at the previous double top and see what the characteristics look like.